And welcome to our webinar, What is the Best Gift for Me Now and in the Future? Just a couple of reminders, we are in webinar format, so you are muted through the presentation, but we are eager for questions and we are a small group, so please don't feel in any way shy about putting questions into the chat box. And I will offer them to Jim along the way. This webinar and the one that preceded it are being recorded and are going to be made available through the diocesan website and also through Episcopal Church Foundation. Jim's presence today is a wonderful partnership, and we're so grateful. We're very pleased to welcome our Bishop, Shannon McVeigh Brown, to open the meeting for us.
The Lord be with you.
And also with you.
Let us pray. Almighty God, whose loving hand has given us all that we possess, grant us grace that we may honor you with our substance, and remembering the account which we must one day give, may be faithful stewards of your bounty through Jesus Christ our Lord. Amen.
Amen.
Well, it is a pleasure to welcome you to this webinar, and especially to welcome our presenter, Jim Murphy of the Episcopal Church Foundation. I'm especially grateful that Jim will help us to bring clarity to some of the questions we frequently have about changes to our tax laws, to providing for our loved ones and the organizations we cherish in effective and appropriate ways, and to how we can truly be faithful stewards of the marvelous bounty God has entrusted to us. So thanks again, Jim, for giving us your time and for what you will bring to us in our time together.
Thank you, Bishop. And let me just commend you on your leadership. I hope that more bishops will take the initiatives you have to try and put in place efforts to raise awareness about planned giving and other ways to raise people's parishes and the diocese to the level of family in their estate plans. And I'll say more about that in a minute. I think Amy's already mentioned that you folks who are listening to the webinar can certainly type into the chat message as they wish. Let me just make sure. Okay, so we had a lovely Murphy's Law experience in our last webinar. So I believe everyone is seeing the latest screen, and I presume everyone saw the screen. Let me just make sure that the screen changed. Everyone should have seen the screen change. So just to get started, my name is Jim Murphy. I'm the Managing Program Director at the Episcopal Church Foundation. The Episcopal Church Foundation, in a nutshell, is an independent and lay-led organization which serves the entire denomination, all of its dioceses, parishes, and related entities. We do this in two main ways, several which the people on the line may be aware of, both in leadership resource development and in financial resource development. Many of you might be aware of our Vital Practices website. This is where we house all of our webinars as well as ongoing updates to help leaders do what God has called them to do in their own particular circumstances. You're aware of the Vestry Resource Guide, our new financial resource guide, etc. And for financial resources and raising and managing assets so that leaders, both clergy and lay of parishes, can do what they're being called to do. I oversee our work in planned giving, endowment management, and of course our donor solutions and donor advised fund areas. So just to jump in, because we'll be a little tight on time, but we certainly have time for questions. And I think it's already been raised that you should, if you have questions, please feel free to type those in. I won't see them. Amy will see them, and Amy will pose those questions from the chat box. So as those come up, please just come to mind, as they come to mind, please put into there, and we'll try and answer all of your questions. And just to be clear, as I said in the last webinar, I am not rendering legal tax or financial advice. I'm raising awareness of a variety of topics, all of which will help you as you reflect on what's important to you, how you can fulfill your wishes and desires through giving, both while you're living right now as well as into the future. And ultimately making a planned gift, potentially, maybe to an institution that you feel strongly about. So at this time of COVID-19 and all of us staying at home, a lot of people have had a lot of time on their hands. I haven't personally. I have never stopped all my busy work that I'm involved in, but many people have had time to reflect on what's been most important to them in their lifetime and think through some of the issues we discussed in the last webinar about fulfilling your wishes and ensuring that they'd be fulfilled. When it comes to making a gift, though, this is also very important for people and going to be different for each individual. So let me just start with a few basics, and then we'll get a little deeper. So to start with, when you're talking about making a financial gift of some kind to your congregation, to your favorite charity, to the diocese, there's different types. First type, ordinary giving, which is most often seen within the context of that annual stewardship drive you're doing at your congregation and that all of you, I hope, give very generously to. Most people make those gifts out of current income. So as income changes, that can go up and down. More and more, though, and I'll mention this in a moment, you're going to see that expanding a bit, where because of various changes and planning, you may make more or larger annual gifts in a particular year. We'll come back to that. Then there are such things as extraordinary giving, capital campaigns, major gifts that you make, typically by making a pledge in one year and then paying it off over the course of several years, or quite honestly, paying it all off at once, if that is what fits for your context and circumstances. Then there's ultimate giving, or planned giving, or legacy giving. All of these are basically the same thing. These are gifts that people make out of their estate or out of assets they're holding for retirement. When someone makes this kind of a gift, and I work with leaders throughout the church to make sure they know this and they recognize it in the right way, these are gifts which are so important to the individual that that individual has raised the parish or the charity to the level of family, to the same place their children and grandchildren are. And it is a true testimony to your conviction and belief that those institutions, those parishes, should continue their good work well far into the future. And that's the key word as well when it comes to planned giving, that these are future-focused gifts. They are normally not intended to be consumed within the regular operating income of the parish. Ordinary gifts are what support the ongoing budget of the parish. Extraordinary, major, and capital gifts support the longer-term aspects of the parish with their building, with building endowment and other things. And then, of course, ultimate gifts are of this kind, where they often go into endowment because they will perpetuate the institution for many generations to come. Now, we are talking very broadly today about giving. And just some starting points. As I mentioned before, I'm not giving professional advice. You should consult with your own appropriate professional advisors. If you are someone who says, well, I don't have any of those, for heaven's sake, you should ask other family members who may have done their estate plans, other people who have done financial planning with an appropriate CFP, a certified financial planner, or someone like that, just so that you have opportunities to work with professional advisors to fulfill your wishes, your desires, and the plans that are particular to you, because every situation, every individual is different, and you need to do what is right for you and your family and your own context. And by seeking the help of others, it is worth the money that you will pay to go through that to ensure that your wishes are fulfilled. We'll get into this deeper in just a moment, but questions that you may have, and certainly are coming up nowadays with all of these recent changes in the tax laws, are when you should give a gift. Should you wait till next year? Should you do it this year? is this year the year that you want to make a very significant gift for one reason or another? No one can answer that question except you, your family, and with the help of your financial advisors. Also, are you in a place where an appropriate life cycle gift would be appropriate? And there's many different options to consider there. So bottom line, know that you are unique. We are all unique, obviously in the eyes of God, but we're literally unique with our own context, okay? So let's go a little bit deeper. And I'm sorry if any of this is going to be too detailed for folks. We will share the slides so you can read over this again. But there's been a lot of changes recently in the last few years. And in summary, again, I'm not giving tax advice, I'm just raising awareness generally. Many, many charities, quite honestly, were scared to death in late 2017 because one of the major changes with the tax laws that took effect in 2018 were that a large number of people were going to stop itemizing their deductions, okay? They were going to stop. And people knew that because you're raising the standard deduction so much higher that it wouldn't be necessary anymore. And there are other things which I'm sure would take us into a political conversation about local taxes. Us here in New York and New Jersey have strong feelings about how much we can take off our federal taxes. However, that was the big change, that fewer people are going to itemize. And what that means for many, many people is that they may consider that there may be a particular year, perhaps a year where their income was higher or other circumstances had taken place, and they wanted to itemize their deductions in a particular year. It's called bunching or batching donations. And what incites people to do that is that it just is the right year for them. Their tax advisors had said this would be the year if you're going to itemize because you're going to have more deductions than you would in the standard. This is the year to do it. And what causes people to do this many times is that they would also like to be charitable. Charitable giving will not be going away. This is so deeply ingrained in the American ethic, and especially to religious institutions. Many religious institutions were afraid they were going to see great declines in giving. They actually haven't yet. But what they are starting to see is what I'm mentioning, that individuals, some individuals, not all, but some individuals may make this choice to bunch or batch multiple years of gifts together so that if they have high trust in their charity, they'll make all of their annual gifts for the next 5 years at once. They may also use a tool I'll describe later called a donor advised fund to make a very big gift in a particular year and then choose to make other grants out of that donor advised fund in the future. This all comes from this change in the tax law that encouraged fewer people to itemize, okay? So, though in the recent changes that took place in 2018 and also some that have just happened, there were some changes that actually encouraged more charitable deductions, and I list them here. AGI, or the adjusted gross income, that figure that everybody is looking for, typically on your taxes when they're looking for Medicare items and all these other things. That amount that you can post against your AGI for taking charitable and other deductions, has been increased to 60% from 50% for cash donations. So that if you're making a significant cash donation, according to the new law, as of 2018, you could make up to 60% of your adjusted gross income in cash donations, which could be beneficial for some people in some years. What changed very recently in the CARES Act was, and it appears to only be valid in 2020, in this year, is that you can actually deduct up to 100% of your adjusted gross income for cash gifts. Now, this will not apply for most people, quite honestly, but if you are choosing this year to be a really significant, big giving year where you're bunching cash donations together, this may be a very useful thing for you to know. And so seek the help of your tax advisors before making those gifts and making those plans. But do note, you cannot make those cash donations to a supporting organization. It has to go directly to your charity. It also cannot go into a donor advised fund, which you keep hearing about, and I'll explain in a moment. For those individuals out there that were very high income earners in the past, before 2018, many of them had to reduce their itemized deductions. That was called the Pease Amendment. Well, the Pease Amendment was repealed. And so for high income earners, you can actually not have your deductions reduced as had been in the past. So a great opportunity for those of you out there that are high income earners. God bless you all. Finally, another change that has happened recently that has gotten a lot of press is, since so many people used to itemize their deductions, and especially for charity, and they don't need to do that anymore, for this year only in 2020, they are going to allow non-itemizers to have $300 of charitable contributions count. So of course you would need to make them to a charity directly. It can't go to the supporting charity, and it can't go to a donor advised fund. But that is an opportunity in this year specifically just for you to know about, and it can benefit a lot of people. This is a lot of complexity, I realize that, but there has, what all of this is driving to is that individuals will be making many different types of gifts, and because some people will be encouraged to bunch their giving into a particular year when they want to itemize, that may well encourage other opportunities like creating a donor advised fund, creating a life income gift, which again I'll mention a little bit later, or making a really significant major gift now to the charity that you support or toward their capital campaign, many of those things. And people might be giving appreciated assets in both to enable them to take a deduction this year. We'll come
Jim?
back to IRAs in a moment. Yes, go ahead.
Jim, there's a question to explain a little bit more about what you mean by bunching.
Yes, happy to. So what this means is that many people in the past had given annually to a charity which they regularly support. And some people may decide that they wish to, in a particular year, itemize their deductions. And therefore, in that year, when they would itemize deductions because they have a higher income in that year, there's some other tax-related reason, and they want to reduce their taxable income by itemizing with an amount greater than the standard deduction, they might choose to make many years of gifts in a particular year. So you'd make, let's say, 3 years of your pledge to your church all in 1 year, and then not give for the next 2 or 3 years. That is what's known as bunching or batching. Batching is what the New York Times called it. Bunching of donations seems to be the more popular. So it's just bringing multiple years of giving together in a single year for those times when you would choose to itemize. Okay, so I presume that makes sense. So when it comes to giving financially, there's many different ways, and we're going to get a little deeper into how to give through an IRA and a donor advised fund. But just a few notes about cash giving. This, of course, includes when you're giving by credit card, by electronic means. All of those things will count as a cash donation. And as I mentioned before, 2020, check with your financial advisor, but this may be a year, if you are interested in itemizing and giving a significant amount in cash, 2020, because you can deduct up to 100% of your adjusted gross income. This might be a year for you to consider if you were thinking about that. Most people give small amounts of cash regularly over time, and that is how most charities and churches interact with the folks who support them. But because there now is more of an incentive to bunch or batch multiple years of gifts, or perhaps to just make a significant major gift because you're at a time in your life, those life-timing gifts where you're at a time in your life where you really want to make a significant major gift for one reason or another, many of those people are using appreciated securities to make those gifts. Believe it or not, many people out there still have appreciated securities, even with the intense volatility of the market. Many people have appreciated securities which they could give, and when you give that as a gift, you avoid paying the capital gain on that. You get the entire amount of the value of that gift as a tax deduction for that year, but you do not pay the capital gains taxes because that is the way this is structured. The capital gain you would have paid if you had sold those appreciated securities separately. Okay. I want to jump into and keep us on time today for giving through an IRA, and I'm going to pause for questions in just a moment. Amy, of course, if there is another question, feel free to jump in. But I want to touch upon giving through a traditional IRA, because this is a way where you can make a very significant gift to one or more charities, and it also can be very beneficial to you as an individual. As many of you know, there are these things known as tax-deferred accounts, tax-deferred retirement accounts, like IRAs, like 401ks and 403bs, where you are storing up assets in these to use in retirement. And typically, they're coming out pre-tax from your income while you're working, reducing your taxable income, then going into an account. And God willing, over time, as being properly invested, will grow in value so that when you are retired and you are ready to make some of those withdrawals, it's at that time that you take those withdrawals, probably at a time of lower income tax rates for you. And so then it's more advantaged to pay the ordinary income tax at that time when you are retired. Now, though in time you will be required, the required date has been moved up in last year in what's known as the Secure Act, where you'll be required to take a deduction, to take a withdrawal from that account at the age of 72. There is also an opportunity, once you are 70 and a half, to make a gift through a traditional IRA and give it directly to charity. And instead of having to pay ordinary income tax on that withdrawal from your IRA, you can actually give it to charity. Now, unfortunately, this only applies when you do this from a traditional IRA. 401k and the 403b, when you take a withdrawal from that, you do have to pay tax on that withdrawal. But IRAs, traditional IRAs, are unique. And you can actually make a gift up to $100,000 directly to the charity of your choice by making what's known as a qualified charitable distribution. Up until recently, this has been a really clear thing. Unfortunately, with the latest changes requiring a minimum distribution age of 72, it's now gotten a little confusing because you, when you are 70 and a half, can actually make a qualified charitable distribution to a charity, but even though you weren't required to make it, you will not pay any ordinary income tax for that distribution to charity. Once you turn 72, the qualified charitable distribution which you make will actually count toward the required minimum distribution, which goes into effect when you are 72. So even though those years between 70 and a half and 72, you aren't required to take a distribution, you have the option, if you wish, to make a gift to charity directly. And when you make that charitable, qualified charitable distribution directly, you won't be taxed on it. And once you turn 72, it will also count toward your required minimum distribution. Now, why is that so important to so many people? And it's interesting, I've talked to many, many people about this. And there are many baby boomers who are turning these ages right now. Many of them are not like people like me who have basically all of their assets in their deferred retirement account. Many of them have other sources of income like pensions and other planning that they had made earlier in life, and they don't have most of their assets in the tax deferred account. And it's honestly, for many baby boomers, a burden to take that required minimum distribution when they hit 72. And so this is actually an opportunity. If you're not desiring to add to your income, not desiring to be forced to take that required minimum distribution once you're 72, you can actually make this qualified charitable distribution to your parish and to other charities and have the amount that you give up to $100,000 count toward the required minimum distribution so that you don't increase your taxable income. Of course, it is just a great tool anyway, even if you're not as worried about meeting that required minimum distribution, but it is a great opportunity. And many, many churches and other charities are seeing people make these gifts. Briefly, a donor-advised fund. So a donor-advised fund is a case where you make a significant contribution now, you receive the full tax deduction for that contribution now, and then in the future, you are able to advise on grants from that donor advised fund to one or more charities. This is becoming more and more popular. Years ago, donor advised funds were typically the realm of wealthier people and people who were more sophisticated in their estate and financial planning, who were also charitably inclined, and they would put significant amounts into a donor advised fund. What is starting to happen, though, is that many sponsoring charities like Fidelity, Charles Schwab, and for that matter, for the Episcopal Church Foundation, who also has a donor advised fund, we are seeing more and more people of average means create donor advised funds. You have to create one with a sponsoring charity like Episcopal Church Foundation or Fidelity or Schwab or a local foundation that you may have within the Diocese of Vermont. But this is becoming more and more of a trend. And the reason that it is beneficial for many is honestly that people are starting to bunch or batch their donations together into a particular year where individuals are doing their itemized deductions. And it just fits for them to use a donor advised fund instead of giving it all to the charities in a particular year. Many people feel it is still important to give to charities slowly over time instead of giving them a large amount all at once. And so by creating a donor advised fund, you can actually make that very significant gift and get that full tax deduction in the year that you're itemizing deductions. And it's very advantageous. As I say, many smaller accounts are being opened, and this is a trend which the National Philanthropic Trust, which tracks these things, is seeing. That as of the end of 2017 and into 2018, when the tax laws changed and fewer people would itemize, you had an increase in people desiring to create a donor-advised fund. and at lower dollar amounts, no longer the multiple hundred thousands, but perhaps less than that, just so that they are able to use the donor advised fund as a tool in their planning. As I said before, giving is not going away. There's this deep, deep commitment to giving. And the donor advised fund, though it won't be appropriate for everyone, is a tool that can be used to really benefit the individual who wants to create it and to create an opportunity for themselves to sponsor the charities they support. The reason it's so appealing is it's quite simple. It's literally like having an account, a charitable checking account, if you will. And it simplifies, especially for younger donors, quite honestly. They like the simplicity. They can make one large gift and then make multiple grants over the course of many years after making that. You can also, you will also find it's quite an easy tool as a philanthropic tool. Most all of the donor advised funds that are out there, especially ones like Fidelity, Charles Schwab, or the Episcopal Church Foundation, are completely automated, and you can do everything that you need to online. Again, this ends up being appealing to people who don't like messing around with postage and verifying addresses. It can all be taken care of for you. It's very flexible, where you decide and advise the charitable entity that's sponsoring it how it should be invested and when those grants should be distributed. So it can certainly be customized to meet the timing that fits for you, with the primary timing, and this is why, again, it's so appealing right now, of bunching or batching a large gift, whether it be cash or appreciated stock or other types of assets, to go into this donor advised fund, and you would receive the full tax deduction in that year when you're thinking of bunching your giving together. Now, anonymous, you can stay anonymous if you wish. You don't have to. This is appealing to some people who don't want a follow-up from a charity. I will tell you, 99% of anyone who gives to a church or a religious institution wants the religious institution to know the donor fund that it came from. So they will not be anonymous, but that is an option when you have a donor advised fund, which gives you flexibility dealing with other types of charities that you may not want following up with you directly. A few quick caveats just to remember, and then we're going to pause for some questions and for me to take another gulp of coffee. Just remember that there is something different about donor advised funds. You cannot pay off an obligatory pledge, such as to a capital campaign where you have made it an obligation that you have to pay a pledge because a building's being named after you or a room is being named after you. The vast majority of parishes do not have obligatory pledges, and that's made clear on their giving card that it is an intention to give. And so just bear that in mind, that if you do use your donor advised fund to make your regular contributions to your congregation, that is fine. Just be sure that you're letting them know that you intend to make those grants out of a donor advised fund, because you cannot satisfy an obligation. And similarly, you can't benefit in any way, either by getting tickets if you are giving that grant to your college and getting football tickets in exchange. And this is all because when you made the original gift to a donor advised fund, it was a completed gift at that time, and you retained the right to advise the charitable entity that's sponsoring the donor advised fund. But basically, most every charity will fulfill what you request in a grant. You shouldn't obviously make grants to non-approved legal structures, and you don't get another tax deduction. This is confusing to some people. You get the tax deduction when you make the the gift, the original gift or gifts over time into your donor advised fund. You get that tax deduction when you make the gift, not a second time when the grant is made. That's because it's a completed gift. You got the tax deduction originally. The grants just simply come out from the sponsoring charity's donor advised fund under your name or remaining anonymous if you wish. Let me just pause there, take a gulp of coffee, and check if there's any questions.
Jim, there was a clarifying question about IRAs and required minimum distributions. Are they waived for 2020?
Yes, I still have to recommend that you check with your provider of your IRA, 401k, and 403b. That is true. Our understanding is that they are waived for 2020, so you are not required in this year to take that required minimum distribution. Okay, thank you. That is a good clarification. I'm sorry I skipped over that. That was one of my notes and I skipped right over it. Luckily, we've not had the technical problems in this webinar that we did in the last. Any other questions? Okay. So we're going to try and get through a somewhat complex topic quickly, but this is all to raise your awareness, to give you an opportunity to reflect as you are thinking through the other wishes you may have to ensure that they are fulfilled in your estate plan, as well as the other aspects of planning for health and funeral and other things we talked about in the last webinar. And this is a repeat of that slide for those of you who weren't there, and you can always listen to that webinar at another time. But it's just important that you do seek that legal, tax, and financial advice when you're getting ready to plan your estate. Use the resources that the Episcopal Church Foundation and other entities would provide. Review your assets, as I said over and over again in the last webinar. Make sure that your family knows your wishes, especially if you've made the choice to make a planned gift to charity, so that there's not going to be any contention with your estate. Okay, now this is a slightly different slide from the last webinar, though very similar. And what I just wanted to clarify is that when you have taken the time with professional advice to review all of your different assets and how it is best to turn over those assets to either other individuals or to charity, or however they are appropriate to be dispensed with at the end of your life, there are some other things to be thinking about when you are considering making a planned gift. As I mentioned at the beginning of this webinar, a planned gift are those gifts that come out of your estate when you pass away at death, or out of assets that you're holding for retirement. Now, I'm going to get into greater detail about bequests in a moment, and then life income gifts after that. But let me just remind everyone and just affirm for those who haven't seen the previous webinar for fulfilling your wishes, that when you've made a decision with professional advice about whether or not you're going to create a living trust to hold your assets while you are alive, and then when you pass away, that living trust converts into a distributing trust, which actually hands out to different individuals and different charities the different gifts that you are making through that trust. That is separate from the assets that will show up under the probated estate, which is governed by the will that you put in place. I'm sorry to say that there are many, many people all throughout this country who have not put in place a written will. And this includes people who need to make decisions in their will about who will care for their children after they have passed away. So I encourage everyone to seek appropriate legal advice when it comes to reviewing all of your assets and making wills, so that the appropriate assets end up in your probated estate. I make this differentiation because wills are public documents. If you create a trust, that is a private document and does not go into the probated process, the probate process. The other thing to be thinking about, and is related to bequests, are pay on death arrangements where various accounts that you may have put together, bank accounts, brokerage accounts, etc., can be also excluded from your probated estate because they could be given directly to an individual or to a charity who only needs to go to that institution with a proof of death, a death certificate, and identification to receive that asset directly. And again, that would stay out of the probated estate. If it isn't specified, it will end up in the probated estate or as is titled into a living trust, depending on what arrangements you have made. I've already mentioned several things about tax-deferred accounts and how they work when you are retired and how you take the income and how potentially you can make a qualified charitable distribution from a traditional IRA. Another aspect, though, in the planned giving area, and this is where many, many assets will end up, that you can also give the remaining assets in your tax-deferred account, whether it's an IRA, a 401k, or a 403b, to a charity of your choice. And that charity will receive that balance completely tax-free without paying any of the deferred taxes that would be owed on it if someone, as an individual, received the remainder instead. Can't get into all of the details of this, but in a nutshell, when you leave it to your spouse certainly has certain rights. And when you leave it to a non-spouse, because of the recent changes with the Secure Act, a non-spouse typically has to spend down what they receive out of that tax-deferred account in about 10 years. And both the spouse and that other person who receive it are going to pay taxes, ordinary income taxes, on all of what they take out of that tax-deferred account. So it may be a great idea to review with your financial advisor and your attorney about leaving the balance of that tax-deferred account to charity instead, who will receive it completely tax-free. It can truly be a ministry and mission-changing gift to your parish and to other charities. Life insurance, very briefly, you can make the beneficiary of term or any type of insurance a charity. And that's a great opportunity to leave a significant gift. You can also do more complex things, such as making a charity the owner and beneficiary of a life insurance policy, which you no longer need. That again gets to be a bit more complex, and I would recommend, if you're considering doing that, if there's a whole life or a cash value policy that you have that is no longer needed by the intended beneficiary, you can speak with your insurance professional about that as an opportunity to make a significant gift to a charity or your church that you support. A lot of times, life insurance, because it is not taxed when it is paid out to the individual, it can be used as a wealth replacement tool. So someone may actually leave certain appreciated assets. This may be a choice that some people make, certain appreciated assets to charity in the rest of their estate, and give insurance to some of their children or other people as they choose, because they won't pay tax on that insurance proceeds which they receive. Again, a complex area, too complex for today's discussion, but if this is something that might work for you, talk to your insurance professionals and discuss this as another type of asset which you could use to benefit charity, either directly or indirectly. Real estate, if you're interested in giving a gift of real estate, as with all major gifts, I would recommend that you talk to the charity, your church, your rector, whoever is a leader at that charity, to discuss whether or not they can even receive a gift of real estate. Sometimes people will create what's known as a retained life estate, where an individual retains the right to live in their home, and then at their death will pass their home on to the charity that they have chosen. That can be a problematic thing, quite honestly. It's sometimes very hard for charities to receive those properties. In many cases, they may not be in the best of shape when they receive them. And as many charities will tell you, they find real estate the gift that keeps on taking, because it can be so difficult to get rid of, and it may not actually be as great of a gift for you to decide. It may be, but if that is something that you are considering doing, and we'll send some resources on all of these different types of gifts after this webinar, if you're considering making a gift of real estate or considering going into an agreement for a retained life estate with your parish or another charity, reach out to the leaders there and discuss what's best for you and for that individual charity. Life income gifts we'll get to in a moment. Those are a tool that not everybody will do, but may be an opportunity for you to make a major gift and then receive income in exchange for that gift. So when it comes to bequests, I'm including your probated will, as well as the trust, as well as those account designations. They all sort of fall into this same category. And this is where the vast, vast majority of planned gifts to your parish or to another charity come from. The vast majority, 80%, even probably a little higher than 80% these days. And you can designate in a number of different ways to your charity. You can make a specific dollar amount. You can put as a percentage of your assets, or you can actually name specific assets. If you name specific assets, once again, I'd recommend that you reach out to the leaders of the parish and just affirm they can actually take the gift that you're making, because it might make more sense for you to make a specific or percentage gift rather than that. Remainder gift. Already mentioned this in another context, but after you have made all of the allocations in your estate plan, hopefully as you have worked through with a professional advisor, you can then leave the remainder of your estate to a charity or to an individual, whichever is most fitting for you. If you're leaving it to a charity, on the whole, those can be very significant gifts, both intentionally and unintentionally. Intentionally, if you really meant to leave the vast majority of your estate, which will show up in the remainder, but it also can be unintentional. And I would recommend that you use the resource we mentioned in the last session, Planning for the End of Life, to help go through all of the different assets which you have and what will end up in the remainder, especially those assets that you may not have yet, that may be coming from another legacy or gift that you'll be getting yourself. Because many times you could end up with more in the remainder than you intended. If you plan well, you can still have your wishes fulfilled whichever way you're seeking. Contingent bequest is what you would think it is. If this happens, then if, God forbid, your spouse predeceases you or your children predecease you, then the amount, the percentage, the asset, whatever it is, can either go to another person or to a charity. And quite often people will introduce planned giving into their estate plans by making the parish or another charity a contingent beneficiary, so that it's a part of their overall plan for fulfilling their wishes. One last note, many people may want to restrict a significant gift to charity. And they may want to restrict it because there may be a lack of confidence in leadership, or there hasn't been a lot of clarity with the parish on how that gift will be used, whether it'll go into the endowment or what's going to happen to it. And I work with parishes and dioceses across the country of putting in place structure and policy to help guide donors to know where those gifts should go and how they're going to be used. I'd recommend, if you are considering restricting your gift to a particular purpose, again, reach out to the leaders at the parish or that charity just to clarify what you're seeking, because it may be more beneficial to not restrict your gift, to give your vestry or another charity the flexibility on how they will use your gift. You may want to designate it to endowment. You may want to designate it to a program. What you don't want to end up with is an anachronistic restriction where you put it into a fund that in time can't be effectively used for new ministry as times change for your parish or for your charity. So do reach out to leaders if you're considering restricting. I'm going to go through my favorite section very fast. So life income gifts. This is something that the Episcopal Church Foundation handles for all diocese parishes and related entities all throughout the country. I have staff in place who are able to work with donors directly and confidentially, because a lot of donors don't want to discuss their retirement income with members at the parish, but they're happy to do it with a confidential outsider like the Episcopal Church Foundation staff. The way these gifts work, and they all work in basically the same way, the donor makes an irrevocable gift. And in the year they make that irrevocable gift, and they may be bunching their gifts together in that year again, to go back to that previous topic, in that year they receive that significant charitable deduction. Then typically the donor, or whomever the donor designates to receive the income, receives income typically for the rest of their life. When the person receiving the income passes away, the remainder of the gift goes to the Episcopal charities or other charities that have been designated at the beginning when all of this was set up. In quick summary, the Episcopal Church Foundation is happy to work with the donors out there that are considering this. And who might consider it? Those people who might be considering such a gift are those who cannot give away an asset or an amount of money out of their retirement assets that they're holding to live off of without in exchange receiving a flow of income back to them. So this is not the gift for everyone, but please know that the Episcopal Church Foundation is the official resource for the entire Episcopal Church for this. We can work with you confidentially, and we are the back office for all of this. We take care of all of the tax reporting, all of the investment needs with our partner, State Street Global Advisors, for handling all of this. We also stay registered as is necessary with some of the gifts. In quick summary, there are 3 different types, and we'll share a chart for this, and then we'll go to questions. I'll share a chart after the webinar. First type, pooled income fund. This is where it varies from year to year because you just get paid the yield that the gift is earning. So you would earn the interest and dividends from the gift that's under management in your pooled income fund. But this will leave the largest remainder for the charity of the Episcopal charity of your choice. The charitable gift annuity is the most popular gift and the one which we spend most of our time at ECF on. This is where you have a guaranteed amount that will be paid to you based upon your age and the amount of your gift. It's going to be a fixed dollar amount that you'll receive guaranteed for the rest of your life. The nature of this gift, though, is that it doesn't leave practically the entire balance. It leaves about 50% on average, and that is because over time you're paying out a larger amount to the people receiving income, and that allows them to have that higher amount of income. But it's still very appealing to individuals who still want to leave that significant gift as a remainder. But even if that gift, let's say you far exceed your life expectancy and markets tank, if that gift reduces to 0, the charity won't receive anything, but you as the income beneficiary are guaranteed to receive the income, and then you receive it from the Episcopal Church Foundation and our endowment, which backs up that charitable gift annuity. The final, which is a more complex vehicle, which is a charitable remainder trust for a much higher dollar amount. The Episcopal Church Foundation can handle these gifts as well, and we can not only provide for you the initial trust documents for you and your attorney to review, which is a real benefit because there aren't that many trust and estates attorneys still practicing out there. Not only is that a benefit, but the Episcopal Church Foundation serves as the trustee, as an institution, not as an individual, but as an institution over your trust, and can take care of that distribution and, again, all of the various tax forms and filings that need to be done. These gifts are not for everyone. They're for someone who, as I said, can't give a gift without receiving income in exchange for that gift. But for those who will find it valuable, it's a great opportunity and a part of planning for the future. We'll send the images of the charitable gift annuity example in the slides. But just to finalize, and this carries through from our previous webinar, this has been a lot of complex detail, but you may desire to give now. You may desire to give next year. It all depends on your particular situation, which is unique to you and your family. But this is a part of your goal to fulfill your wishes, to ensure that the way you want your assets handled when you pass away are handled in the appropriate manner. I'd encourage you to listen to, if you haven't seen it already, the previous webinar on fulfilling your wishes. But please do discuss this with people, ensure you have documentation and copies and records to share with the people who will be advocating for you and other members of your family so that people know what your intentions were. So let me just pause there for any other questions we might have.
Jim, we don't have any questions in the chat.
Okay.
That doesn't mean there won't be questions in the future.
Well, let me just wrap up very quickly then. So all of us at the Episcopal Church Foundation are here to help you on our Vital Practices website. As originally mentioned, we have all of our webinars recorded where this is recorded. If you're in the Diocese of Vermont or in another state and listening to this and getting the information, all of us and my team at the Episcopal Church Foundation are happy to serve you and help guide you toward the resources which will be beneficial to you and helpful for ensuring that your wishes will be fulfilled, both from medical care, funeral planning, as well as your estate and your retirement planning. So we're happy to share all these resources, but please do reach out to appropriate legal, tax, and financial advice before finalizing any plans, because it's worth the money to spend to ensure that your wishes will be fulfilled both now and in the future. Any other questions? So without further ado, since we're right on the borderline, I shall turn it over to your fantastic bishop, who is one of the people, along with Amy and Chris Chapman, who put all of this together today. Bishop.
Well, thank you so much for your time, Jim, and those of you that listened. And one of the ways that we can make sure that this good information gets out is to tell our friends and invite them to access the recording and other materials on the website, as they will be housed there shortly. That's all I have to say. And thank you so much, Amy and others, for making sure that we had this time together and this opportunity to learn.
Thank you, Bishop. And I look forward to, as all of us at the Episcopal Church Foundation do, to serving you in this early time of your episcopacy and to help to support you to do what God's called you to do in this very unique ministry. So thank you, Bishop.
Thank you. In fact, this reminds me of one of the conversations we had during walkabouts is, you know, how to get people to feel more comfortable with making these kinds of plans. And this is, I didn't imagine that we would be doing this in the middle of a pandemic on Zoom, but I'm glad that we'll have these recordings, and we might not have thought of making recordings if we had gathered in a place and had a typical conference that we had originally planned. But anyhow, so I'm just glad for this opportunity.
Okay, thank you. Have a great day, everybody. Amy, any last words?
No, thank you all. Thank you so much. Thank you, Jim.
Thank you.
Have a great day.
Bye.
Bye-bye.